There's a number that was changed last Tuesday. You didn't vote on it. You weren't asked. You probably didn't even hear about it. But that number will decide whether you can afford to buy a house this year, whether the company you work for starts laying people off, whether your credit card debt quietly gets more expensive while you sleep, and whether the economy you live inside of grows or quietly begins to shrink. One number, set by a group of 12 people in Washington, and almost none of them were elected. This is about the federal funds rate. And once you understand what it actually does, you'll never look at a news headline the same way again. Let's start with something that sounds boring but isn't. Banks lend money to each other overnight. Every single night. It's routine, almost mechanical. One bank has excess cash. Another needs to cover its reserves. Money moves between them. And by morning, everything balances out. The interest rate on those overnight loans is called the federal funds rate. And on the surface, it sounds like an administrative detail. An internal banking technicality. Something that lives in a spreadsheet somewhere and affects no one outside a conference room. Except it doesn't stay in the conference room. It bleeds into everything. When the Fed raises that rate, borrowing money gets more expensive across the entire financial system. Mortgage rates go up. Car loan rates go up. Credit card APRs go up. Business loans get more expensive, which means companies borrow less, invest less, hire less. And when the Fed cuts the rate, the opposite happens. Borrowing gets cheap. Money starts moving. People spend. Companies expand. Asset prices rise. One number, transmitted through the entire economy, like a signal through a wire. Here's where it gets uncomfortable. The people who set this number are members of the Federal Open Market Committee, the FOMC. The committee includes the 7 members of the Federal Reserve Board of Governors, who are nominated by the President and confirmed by the Senate. So far, so democratic. But it also includes 5 presidents of regional Federal Reserve banks, who rotate on and off the committee. And those regional bank presidents are not elected by anyone. They're chosen by boards that include, and this is not a conspiracy theory, this is just how it works, representatives from the private banking industry. The people influenced by interest rate decisions have a formal role in selecting some of the people who make interest rate decisions. You can agree with that structure or disagree with it, but you should at least know it exists. Now let's talk about what this number has actually done to real people. In March of 2022, the federal funds rate was effectively zero, practically free money. Mortgage rates were hovering around 3%. A family buying a $400,000 home was looking at a monthly payment somewhere around $1,700. 18 months later, after the most aggressive rate hiking cycle in 40 years, that same mortgage on that same house was costing closer to $2,800 a month. Same house, same price, $1,100 more per month. Not because the house changed, not because the family's income changed, because 12 people in Washington changed the number. Millions of people who had been planning to buy homes in 2022 and 2023 simply couldn't anymore. Not because they were irresponsible, not because they failed, because the math stopped working for them. And simultaneously, people who already owned homes, who had locked in rates at 3%, were effectively frozen in place, unable to sell and rebuy without taking a brutal financial hit. The entire housing market seized up, and the Fed knew it would. That was, in a technical sense, partly the point. This is the part that tends to make people uncomfortable when they really sit with it. The Fed's primary tool for controlling inflation is making life more expensive for people who borrow money, which is most people. The theory is that when borrowing gets expensive, people spend less, demand falls, prices stabilize. It works. Historically, it does work, but the mechanism requires ordinary people to feel financial pain. Job losses, stalled wages, underwater loans. These aren't unfortunate side effects. They are the instrument. The Fed doesn't target inflation by going after the causes of inflation. It targets inflation by slowing down the people living inside of it. There's a term economists use, demand destruction. It's a clinical phrase. It sounds neutral, but demand is just another word for what people want and can afford. Destroying it means making people unable to buy things they previously could. That's the mechanism. That's what's actually happening when the Fed tightens. And yet the Fed is also the only institution with a tool powerful enough to prevent something worse. Uncontrolled inflation destroys savings. It wipes out purchasing power. It hits the poorest people hardest because they have no assets to hedge with. No stocks rising to offset the rising grocery bill. Hyperinflation isn't a thought experiment. It's happened within living memory in countries across South America, in Zimbabwe, in post-war Europe. The Fed exists, in part, to make sure it doesn't happen here. That's not nothing. So this is the real tension. The institution is imperfect, non-democratic in meaningful ways, and wields enormous power over ordinary lives. And it may also be necessary. Both things can be true. Usually the most important things work that way. Here's what you should carry with you after this. Every financial decision you make, when to buy a home, when to take out a loan, how much debt to carry, where to keep your savings, is being made inside a framework controlled by a number you didn't set and can't vote to change. Understanding that number, watching it, knowing what the Fed is signaling and why, is not something reserved for economists or Wall Street traders. It's basic self-defense. The question worth sitting with is this. If a single interest rate can reshape the financial lives of 300 million people in 18 months, what does it mean that most of those people have never once thought about how it gets set?